right now in this record, I'm gonna tell you more about what are the components of the banking offer and how to choose, how to pick for you the most suitable one. I would say there is like 5 steps. Banking offer. There is 5 steps and we're gonna go through all of them to always compare and choose the best one, the most suitable one for you. So the first one is gonna be bank's margin, which is just the annual interest of your mortgage that the bank is gonna charge you, and that's just the revenue of the bank for giving you money. So it's gonna be bank's margin is gonna be just X%. It doesn't matter. It's just the pure margin rates in each bank to compare. The second one is gonna be possible commissions. The third one, it can be commission for preparing the mortgage, preparation commission. There can be overpayment, repayment earlier commission. We're gonna speak about this later. And then the third one is a few kind of insurances. I'll do this icon. Okay. Then we're gonna have real estate and appraisal, just evaluating the value of this of the real estate that you're buying. So it's gonna be insurances, real estate, appraisal, and the last one is just gonna be the cross-sell. Cross-sell additional cost, the things the bank's gonna encourage you to take to become their client. Cross-sell, like opening account, transferring your salary to the new account. They're taking special debt or credit cards, wherever. So commissions, we may have preparation commission, commissions for, let's say like this, preparation. So it's just simply saying, let's say simply, when you apply for the mortgage and the bank is gonna giving you a positive decision, there is no fee for that. But once you really launch the first tranche of the bank, you use the credit, they can give you the preparation commission. Of course, before you even apply, we're gonna know if you have it or not in the offer. So that's the commission for entry. Then for overpayment, and for, I would say, repaying early repayment. Repayment. What does it mean and what's the difference? Preparation is only for entry. You're gonna pay it once, no one's gonna give it back to you, and just that's it. You're gonna lose this money. But overpayment, it means that you're paying more the capital than you have from the schedule with the regular installments. So let's say you should pay 2,000 per month, but you're overpaying. You're paying 3,000-4,000 per month. Not each month, but when you just want to, when you're in the mood to overpay, you have some savings, you're doing this. So in some of the banks, they can have commission for that. They can charge you, but only within the first 3 years. It's by the law. The law, it's giving very strict regulations to the market that they cannot charge you after 3 first years. But still, if you want to overpay within this period, let's say right now half of the banks, they can still charge you there. Early repayment, it's something else. When it can occur. For example, you sold the apartment, house, whatever. You sold it before the 30 years old, the 30 years of the mortgage. Then you won on the lottery. You sold your house in Norway. You just want to move the savings here, and you want to close the whole mortgage on the timeline. Just for instance, this is 30. Here is start. Here is 0. And if, let's say, you took for this 30 years and you close it before this 3 years, there may occur the commission as well for overpayment and early repayment in total. All right. Insurances. We have, I would say, 5 kind of them. First one is going to be life insurance. Second, unemployment insurance. Unemployment insurance. The third one is going to be low contribution insurance. Bridging insurance. And the last one, let me think, real estate insurance. All right, the first one. Some of the banks, generally speaking, most of them, they're gonna rather require some kind of life insurance just from your dad. At least one person, if you're applying with your partner, then just one of you supposed to have the life insurance. Some of them, they force you to get the policy that they sell as a bank, which is going to be rather more expensive than the regular market one. But some of them, they're like more fair. I don't want to put the names here, as I said, but they're gonna say just like take your group insurance from the corporation, do your own policy on the market from like third-party company, and just make sure that you make a decision of the right. If something happens, the bank is how to say it, like in charge to take in the first place the money from the commission, from the insurance. That's the first thing. It can be quite expensive. Some of them they require only for the first 3 or 5 years. Some of them they're gonna require for whole period of the credit of the mortgage, and some of them they're gonna say we force you to take at the beginning. You can cancel it without any penalty afterwards. They're not gonna raise the bank's margin. And the last scenario is that they're gonna require from you all the payments for this life insurance on the very, very beginning. It's rather with the unemployment insurance. Some of the banks still, they just charge you on entry. It's a lot. In some banks, it's even like 3.25% of the whole amount of the credit, the volume. In advance, you need to pay exactly like a preparation commission. That's a different story. Low contribution is the loan down payment. If you have 10%, it's that 20. Even though if you have 19%, 19.9, then still you are not meeting this 20%, which is obligatory according to a financial supervision committee, and they're gonna force you to have some of low contribution insurance as a policy or just like a higher margin rate. Bridging insurance. It covers all the period before the mortgage is in the fourth register, the fourth chapter of your register of the apartment. You may ask, what if my apartment is still under construction or I don't have a register set yet? Good point. Then you need to wait the time that normally you would wait for putting the mortgage there, which depending on the city, it's sometimes a few weeks, sometimes it's long months, up to 1 year. It really varies on the city in Poland. And if the apartment's under construction, then you need to also add to this period a few months or even 2 years. Sometimes it's even 2 years when you're just buying the how to say, like ground where developer is starting the investment. So you may also ask how much is going to harm you. Let's say it's approx 1 to 1.5% of the annual rise of the bank's margin. So if you, for example, take approx 800K, the volume of the credit, it can be 6, 7, even 800 monthly increased of the interest part of your installment. It's a lot if you multiply by, for example, 24 months of waiting. You cannot avoid that. It's just like to make sure that bank is secured, bank is not taking any risk. If something goes wrong with developer or the money of the seller, of the mortgage will never go to the register, then bank is secured with the bridging insurance. Who is paying for that? Of course, you as a client. It's always like this on the market. And then the fifth and the last one is real estate insurance. It's very simple, it's obligatory, and very often it's the bank is not forcing you to take the one from the bank's offer. So they force you to be secured, to be, how to say, to have this policy. We call it from fire and the walls. So from just the collapsing the whole construction into from the flood, for example, from the water, depending on which floor you live, and from the fire, just like the fire is gonna consume your apartment. So they want to be sure that if something bad happens, then they have the money from the insurance company is gonna cover all the mortgage that you took down here. Making the long story short, it shouldn't, with some exceptions, it shouldn't rise the offer in general. The real estate appraisal. If we speak about the separate house, it's gonna be approx 1, even 1 point something K. It's just something you pay at once, you know, like you don't pay it annually, you don't pay it monthly, you do it once and you're done until you don't want to change, you don't want to refinance the credit to another one, because then you need to prove the value of the apartment or the house again. After 1 year is gonna be, let's say approx 1 year is gonna be expired, so then you need to refresh it or do the new one. If it's about the regular apartment, I would say it's gonna be around 600-700 just for the appraisal, the valuation. That's it. And some of the banks, they require the external, some of them internal. You also remember from the first video. We do recommend to do with the professional external one, but sometimes you are forced to take the internal one, and you can do nothing. You can do nothing about that. The cross-sell. It can be a new account. Account. Can be a credit card. Transfers. And so on. So some of the banks are gonna not force, but encourage you with the way better offer, promotion, the action of the mortgage deal, to open account, maybe take additional credit card, or just to move your salary, or at least do the transfers like from account to account, you know, like movement of money on your private account there, to kind of convince you to be their client, you know, to move all your products. You don't need to do it, but it's very often like the standard offer without the cross-sell is way more expensive, way higher than just taking with the small, maybe not too comfy, but still not very harming additions. So, you know so far what are the components of the banking offer. Right now you may ask the question, so what we're gonna do with this knowledge? Of course, that's our job to tailor, to prepare the conception, tailor the most suitable offer for you. But to give you the teaser, how we're gonna do it and how's the first step of comparison, it's the most critical part is to decide if you are like long runner, so you are taking for 30 years and you don't want to overpay earlier and you want to keep it for exactly 30 years without selling earlier your estate, doing nothing, you're not touching the credit, you're not refinancing to a different bank, or you are a flexible person and you think that, okay, on the paper I'm taking for 30 years, but I want to be flexible. If there is better offer in different bank, it show up in first or second year, I'm just like going to different bank, right? I'm refinancing from A to B, you remember that. So you can do wherever you want, of course, but sometimes you're gonna pay commission. So how to avoid this commission? To avoid that, you just need to pick the offer without any commissions for entry and for overpaying or closing the mortgage before the time. As you remember, that's the critical period, this first 3 years. So if you don't have in your offer any of those, then you don't gonna regret that you paid something in advance, right? You didn't put like any cash on the table in the bank in order to pay commission for entry or for overpay earlier. So you don't care if there is better offer in different bank. I just calling you and I'm telling you that you're gonna save a lot of interest monthly. Just let's prepare new financial documents, new application, and let's refinance to bank B. Then you're gonna probably agree on that. So then you rather don't want to pay anything on earn entry, and rather you don't want to have any commissions, to be free, to be flexible. There is always pros and cons. So what's the price that you're gonna pay for that, for this flexibility? Probably you're gonna pay it somewhere else. So if bank is not earning money, taking profit on you in this part, they're gonna take the profit here as an interest rate. So they're gonna say, all right, if you want naked offer with 0 on entry and 0 for overpaying earlier, even within these 3 years, we're gonna charge you with higher interest. It's not gonna be a significant difference, but still, if you really calculate in Excel or for 30 years in a, how to say it, like in Excel formula, you're gonna pay way more interest. So it's clear that bank is gonna almost always take a profit on you. But the main question is where and when. Where rather means like with what, on which part of the table here, and when on the timeline, because the interest is gonna harm you on the whole period of time, all the each month installment, right? If you pay commission, it's gonna harm you on entry or the maximum the third year. If you don't care about that, because you know that for 5 first years you are not touching the mortgage, you're not overpaying, you do nothing with that, then you don't care, right? So with those additions, and for example, some additional insurances, policy, those things here, you're actually kind of buying the cheaper bank's margin, the margin rate. So one more time, if you want to keep it for a long time, you don't care much about the commissions, because somewhere in time they're gonna balance on 0. It's very easy to prove. You're just taking the commission that you're gonna pay on entry, dividing per the difference of the monthly interest part, how much you pay more comparing to the naked offer without the commission, and then you divide it per 12 in order to say it in years. And for example, in this particular offer of this bank, you're gonna be balanced on 0 on the, for example, 17th year, right? So somewhere on the half. So with this information, you know, if you're gonna touch the real estate, you're gonna sell it earlier, or you're gonna repay part or even all the mortgage with some savings. You sold your house in Norway, as I said, and you take the savings down here. Then if you touch the mortgage before 17 a year, then you're losing money because no one's gonna give it back to you. But if you're gonna keep it forever, like for the 30 years lifetime, then the sum of those commissions, of those insurances, plus the lower interest part, probably is gonna be slightly cheaper than the naked offer if you would take only without these additions. The cross-sell is not a big deal, it's just like a few zlotys monthly, so let's not focus here. I told you how much you're gonna pay for that. If there is something else to add on this, I don't think so. We are done with that. So, one more time. If you prefer flexibility, you want to overpay, you don't really want to keep the offer in the one bank for 30 years, go with naked offers without any commissions on entry and overpaying, with higher monthly installment and higher bank's margin. If you know you're sure that you're taking this for 30, 20, whatever, but very long term, and you want to keep it there, just buy the better offer with some additions. We always keep in mind, we always manually really write down on a paper, Excel, whatever. We make the comparison for you from the best 2 or 3 banks that we're gonna pick, the best offer, and we always gonna tailor it exactly to your needs. So if you're gonna say, oh, I want to have life insurance anyway, so it's not additional cost for me because I would have it even though they would never, the bank would never require this from me. That's fine. It's a good information because then we can go for a better offer here. And I can say the same. It applies to everything here. So depending on the offer that we're gonna have on the table, we just need to even in the same bank name A, they can have 2, 3, 4 different offers to to choose, right? So that's the whole magic that we need to do on the meeting. Thank you for your attention and see you in the next recording.